Imagine October 28th, 1929. Before lunch, $14 billion simply vanished. Poof, gone. What happened next wasn't just a stock market correction. It was the start of a decade-long economic nightmare that fundamentally reshaped America and the world. And here's the most terrifying part. Nobody saw it coming. Not the bankers, not the politicians, not the average investors. Even though, as we'll uncover today, every single warning sign had been flashing bright red for months. We're going to show you exactly what those signs were. And then, we're going to compare them to a list of identical red flags that are flashing right now, today. This isn't just history. This is a chilling premonition. To truly grasp the devastation of 1929, we first need to understand the intoxicating mood that preceded it, the Roaring Twenties. America was living high. Post-World War I, the economy was booming, new technologies like radio and automobiles were transforming life, and the stock market was soaring. It had tripled in just 5 years. Everyone, it seemed, was getting rich. People were buying stocks with borrowed money, a practice called buying on margin, sometimes putting down only 10% of the stock's value and borrowing the rest. Consumer debt was exploding, fueled by the exciting new invention of the installment plan. Everyone from seasoned bankers to the kid shining shoes was giving stock tips. There was a famous warning back then. When the shoe-shine boy starts giving stock tips, it's time to sell. But no one listened. Optimism wasn't just an emotion, it was an economic strategy. Despite the widespread euphoria, cracks were appearing, and they were visible. March 1929, the Federal Reserve, the country's central bank, issued a stern warning about excessive speculation in the stock market. It was largely dismissed. September 1929, the stock market began to show unusual volatility. There were sharp, unexplained drops, followed by quick recoveries. The media downplayed it, calling them temporary adjustments. September 5th, 1929, a renowned economist, Roger Babson, publicly predicted that a crash was coming, stating, "Sooner or later, a crash is coming, and it may be terrific." He was openly ridiculed by his peers. September 3rd, the Dow Jones Industrial Average hit its all-time high of 381.17 points. It would take another 25 years, until 1954, for it to reach that level again. These weren't subtle hints. They were blaring alarms. But in an atmosphere of unchecked optimism and greed, everyone believed they were too smart, too lucky, or too different to be affected. The avalanche began on October 24th, 1929, Black Thursday. Panic selling hit. 12.9 million shares were traded, more than triple the normal volume. The market plunged. Desperate bankers pooled $130 million to buy up stocks and stabilize the market, which worked temporarily. But it was just a brief reprieve. On October 28th, Black Monday, the market crashed again, even worse than Thursday. Investors were in a full-blown panic. Then came October 29th, Black Tuesday. On this single, horrific day, $14 billion in market value evaporated. To put that in perspective, that's roughly $240 billion in today's money. It was utter chaos. The ticker tape, which relayed stock prices, couldn't keep up. It was running 2.5 hours behind. Traders didn't even know what prices they were buying or selling at. The entire financial system seemed to be dissolving in real time. The crash was just the beginning. The years that followed were a testament to human suffering. Between 1930 and 1933, a staggering 9,000 banks across the country failed, wiping out the life savings of millions of ordinary Americans. Unemployment soared to 25% by 1933. The nation's gross domestic product, its total economic output, fell by a crushing 30%, a level of economic contraction that wasn't recovered until the massive industrial buildup of the 1940s and World War II. The psychological toll was immense. Suicide rates among wealthy investors spiked in major cities. Families lost their homes, their farms, their dignity. As many historians point out, the crash itself wasn't the tragedy. The decade of despair and poverty that followed, that was the true tragedy. Now, let's fast forward to 2026, and let's look at those warning signs again. Margin debt at record highs? Check. Retail investors are once again borrowing heavily to invest. Retail investor participation at all-time highs? Check. Everyone seems to be an expert in trading meme stocks and crypto. AI/tech stocks at unprecedented valuations? Check. We're seeing price-to-earnings ratios in the tech sector not seen since 1929 or the dot-com bubble of 2000. Trade war escalation? Check. As we discussed in a previous video, tariffs and protectionism are back on the table. Federal Reserve caught between inflation and recession? Check. The Fed is walking a tightrope, trying to cool inflation without tipping the economy into a deep downer. Widespread optimism despite underlying cracks? Check. Despite warnings from various economists, the prevailing mood is often one of buy the dip, and it's different this time. This isn't a prediction. This is a pattern recognition exercise, and the patterns are eerily, terrifyingly similar. The people living through 1929 weren't stupid. Far from it. They were ambitious, hardworking, and above all, deeply optimistic. But optimism, without the sobering clarity of historical context, can be a dangerous, even catastrophic, thing. They believed in endless growth, in a new paradigm where the old rules didn't apply, and they paid a devastating price. History doesn't have to repeat, but its lessons are always there, waiting to be learned. The question is, are we learning them? Or are we, once again, too optimistic to see the red flags? If this deep dive into Black Tuesday and its chilling parallels to today made you reconsider the world around you, then you absolutely need to subscribe to Histovra. This entire series is dedicated to giving you the historical context that the daily news often misses. Hit that subscribe button and ring the bell to stay informed.